And obviously, what we're dealing with here is the aftermath of a banking crisis, which historically takes about 10% off the loan book. So if you look at the size of the loan books of the banks going into the crisis and the size of the capital base they had going into the crisis, then in many cases, if you look at a situation where you've got a finished crisis like the US, you can now see that losses are 2.5, approaching 3 times the starting capital. Now that's not a problem you can deal with in 1 year. You have to deal with that problem over a lot of years of retained earnings, and at the end of it, or in the middle of it, you may find you need to raise some capital if you can.
It's been ongoing though. I mean, we've had about 4 capital raisings at Deutsche Bank since 2010, kitchen sinking, now kitchen sinking and a pivot. So at what point do we get past all the crisis issues and start to look forward? Do you think this is the moment for the likes of Deutsche, for instance?
It's difficult with Deutsche because Deutsche went into the crisis with hardly any capital. Now, its argument is it also went into the crisis with hardly any risky assets. But the trouble is it doesn't take very many risky assets or risk-free assets to make a loss before you're using up a good chunk of that capital. And so whenever Deutsche got hit by unexpected items, like for example the DOJ judgment, that means that they had relatively small amount of reserves to call upon. And the real problem with rights issues once you're into a resolution period is that you're already now finding your share price is quite low. You don't want to do a rights issue when nobody thinks there's anything wrong and your share price is nice and high. It's very difficult to raise significant amounts of capital when your share price is lower.
Philippe, come into the conversation because you see an opportunity moment for some of the European assets, particularly in the banks.
Yeah, banks in another world as well, because if you look at it, we can have issues in the European economy, we can have issues with banks, we can have issues everywhere, but at this moment growth levels are nice. European growth is twice the potential, interest rates are low and rising, that's fantastic, and the euro is low, so when we have issues it will not be 2017, 2018, potentially later.
James, do you think there is a silver lining in this Deutsche Bank story? Yes, they're going back to shareholders cap in hand, yet at the same time they're also flagging up the first dividend in more than 2 years, even though it's only 19 cents. But essentially, this is a very strong reason for investors to buy this firm. Do you think investors will look past the capital hike once again?
Well, it's kind of a strange way to look at it from an investor's point of view, because what they're basically saying is you give me £20 and I'll pay you 5p back. I mean, this is what the timeshare guys used to do. They used to say, buy this property and I'll guarantee you an income for the first 3 years, but the income they were guaranteeing you was your own capital. So I don't think that alone is a great reason to buy Deutsche Bank. But Deutsche Bank's already doubled since its lows of last year. So there's a lot of flexibility in the share price. People say, oh, hold on, I wasn't expecting a rights issue. I don't know why they weren't, but if people were thinking that, I might take some money off the table now. I don't think it necessarily means that things are catastrophic.
Strangely,
for
people
Deutsche.
seem to believe the CEO. Who would think?
Yeah,
but
right.
You'd think they'd learn.
But James, the other big deal we're seeing this morning across the market is Standard Life and Aberdeen. This is almost an encroachment into the asset management space as some of the banks try to retain and bulk up on asset management as well. The borders are crossing, a little bit like before the financial crisis where bank assurance was the big model. Are we looking at a new landscape now in financial markets here in Europe?
Well, it's a very good sign in a way. I mean, if you look at the net interest margins of banks in the US, they're significantly higher on a long-term basis than we see here in Europe. And the reason for that is that basically they've got lots of local monopolies owing to historical factors that give banks in their own regions a lot of say and a lot of ability to charge borrowers a lot of money. If you look over in Europe, that's not the case. So net interest margins are much lower, which means banking is much more competitive. That's great for bank customers, but it means that the banks really need to be looking for some other stable forms of income. They used to like FICC, but of course that's not that stable, and increasingly the capital costs, because of regulations, are going higher and higher.
They did like it last quarter, though, didn't they?
Yes, but that's the trouble. It's quarter by quarter, and more importantly, more fundamentally, that the regulators are now demanding higher capital costs. So they're looking for nice, stable types of businesses that fit nicely with their own businesses, and that have high retention power. And fund management has always been one of those businesses.